to the Capital Discussions OptionVue Education webinar series. Today is September 21st, so I guess it's the first day of fall. I have Jim Graham from OptionVue with us, but before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with the disclaimer out of the way, I will pass the ball to you, Jim. And Jim, welcome. I think this is the first time you've been with us, but we've known each other for quite a while, so it's a pleasure to have you here.
It's a pleasure to be here, Tom. Let me just share my screen, and I will also have a little slideshow. Hopefully you can see this okay.
Yep. Looking good.
I'm the COO of OptionVue Systems. I worked for many years as product manager and working with Len on developing and enhancing the software, OptionVue 7 software. Today I thought I would focus more on the matrix and particularly the modeling and some of our new features that people may not be aware of. For those who are familiar with OptionVue, the matrix is really the home base of the software. Almost everything you do is in the matrix. I'll just show also, as you had shown, I have a little disclaimer that this is all educational. I might show some trades just for purposes of demonstration, but for the most part, these are not trading recommendations. So let me just go right to my OptionVue. And OptionVue can be set up in many ways, but I keep at first all of the various indexes and main markets, equity markets. I also follow, of course, all the futures markets. I'll talk a little bit about the difference between some of the equity markets and futures markets in terms of modeling. I think the majority of people are equity traders or stock traders. And let me just open one of the biggest ones, something like the SPY. It follows the S&P 500. And there's many options available. I'm not showing the weeklies. I'm just showing the regular month. But here in the matrix, you can have a legend that tells you what you can show. And right now I'm just showing the market price of each option, its MIV, and then any trades or existing positions I might have. In this case, I don't have any. Just want to show in the model, though. That's where I'm going to focus first. And when we talk about the model, we're really talking about modeling volatility. And that's the very first button here. When we're modeling volatility, we're really looking at, first of all, what is the current volatility situation? And we're also measuring all the past history of the volatility to calculate what we call CEV factors, or constant elasticity of volatility. And then we're using that, both the past history and the current market, to project in the future at various prices of the underlying what it will be worth. So before I actually dive right in there, I'll just put in something like a straight calendar spread and hit the graphic analysis. Because graphic analysis is one of the key parts, and this is what the modeling is really used for. It's projecting at every different price of the underlying how much you will make or lose, either in percentage terms on the right here or in dollar terms on the left. And at various times, the short dotted line is what will happen today. The next line is a T plus 13 line in 13 days from now, and then the last line is at expiration. So we're choosing any particular point, and we have to calculate for every single price at every single time, if I come out here and do something like 205, I'll make it a nice even 205. I can hit this details button. This details button in the lower right corner is really key for understanding what this graph is saying. And when I click on the D button, it's going to show you that at this projected date, at this price, and with this projected volatility change, in this case no volatility change, here's what your position would be worth. It shows each individual leg, what your position and the price that you enter it in, or in this case it's a trade, so it's estimating you'll enter into it. And then it's going to show you the actual volatility change it's projecting. So at this price, on this date, this 196 call will be a 39.4% volatility. Why that is important is that when you're calculating what the fair value of an option is, what it is worth, you're using the main information of the underlying price versus the strike price, and then the amount of time left in the option, and then volatility. And there's a couple of things like dividends and interest rates which have a small effect, but the key thing is volatility. You know the price, you know the time, you know the strike price. The one thing that you're trying to make your best estimate or best guess at is what will be the volatility. So that's what makes volatility modeling so crucial. Now I'll just close this and go back and look at that 196 option, and you can see right now it's at 18.6. So that's a big shift it's projecting, but then I projected a huge shift in price up to 205. So at that point it's going to be like 9 points in the money. All right, so let me go back into this model and look at the volatility. I'm going to start here. There's 3 tabs: the horizontal skew, the vertical skew, and other. Start with the vertical skew. The vertical skew is what is often referred to as the volatility smile. And the volatility smile or curve starts with the at-the-money option being at the very bottom of the curve. We can actually choose one of these and look at the skew graph. It doesn't look quite as much of a curve here because we're looking right at the money. You can also look at both. You'll see it shows all the various measured IVs of each individual option, and then it's drawing the best fit curve through there. I will mention it's a little easier to see it if you're looking on this manual skew graph if I choose one. But again, you can see each of those dots is a measured volatility, and it's just drawing the best fit curve. As you go farther out of money, it will begin to curve up, and it's definitely going up here. Now there's so many strikes in the SPY that looks almost more like a straight line up. But measuring that curve is the first thing, and you can see this in the matrix itself. Here's the measured MIVs. But let me just change one of these columns to what we call projected volatility. The projected volatility is the, let me go back to the variable. The projected volatility is the best fit curve, and what the OptionVue is actually going to use to value this and to do things like calculate the Greeks down here, the delta, gamma, theta, vega. And you can see there can be slight differences because here's the 196 call here, it's at 18.8, it's on 18.7 on the curve. As you go farther up, you might see even a little more difference, but it's still pretty close because the SPY is a very tight market with very good bid-ask prices coming in. But you can see how it starts here at like 12.9, 11%, goes up to 15, 16. You hit 18 here about the money, 19, 20s. And then you'll see the exact same pattern in the puts. So then you can draw individual curves based on the calls and individual curves based on the puts. And in the model, we do have where you can use a combined call-put skew if you want. We use as the default to not use the combined, to use the calls put or the call skew to calculate the value of calls and the put skew to value the values of the puts. But there are some exceptions to that, and it's a very low volume stocks with very few options trading. If there's less than three strikes, or it's trading less than, I believe, $5,000 in options a day, it will default to using the combined call-put skew automatically, because there's simply not enough data to draw very good individual curves. And you can see this in the vertical skew. Here's the calls. And if you use combined, it's going to use here the average of the two. It's just going to average the two lines. So now when we're looking at a projected price, it is moving along that curve. So that's how it's projecting part of the shift of the volatility when it's saying it moves from, say, today, 196 to 97, $1 up. It's going to look, what is the reading of volatility $1 up on the curve right now? So in this case, you can see it pretty easily. We'd say if the SPY moves up $1, it's going to move from this at the money 18.8 to 18.4. So we're going to project a 0.4% decrease in volatility just based on the volatility skew curve. But one thing that we've been working very hard on this past year, and this is where it gets a little more complicated, is the horizontal skew. In the horizontal skew, we're actually measuring each individual month. You can see here we're using a 30, 60, 90-day, 1 year, and 2 year. And we're measuring what the volatility is for each of those time periods. And then over here and to the right, you can see there's a graph that's showing, in this case, again, very flat. We'll look at some more later on that are going to be a little more interesting, but I want to use this because it's a very well quoted, very liquid market. And you can see underneath projected changes in volatility based on price changes in the underlying. And so you can see as the price changes a lot, especially the 30-day is going to move a lot more than the farther out 1 and 2 year. And so what we're doing is we're actually going back looking at the past history, and we're calculating these CEV factors in this table. Now, over time, this is going to move, and you could actually grab this and move it and project a change yourself, and then it will use it in the modeling. If you click this button, it'll bring you right back to 0, flatten it out. You can see this shading here, and this shading shows you where this has been over the past 3 years. So in the past 3 years, it hasn't always been super flat like this. You can see at one point, it hit a point where it was, it looked more like this. More of a big curve where it was very high in the front months and low in the back months. So let me just, before I put this together, let me just show you our Volti chart. And in the Volti chart, you could look at this 30, 60, 90-day, 1 year, 2 year, right in the chart. And when you click in, you can see here's what the current situation is. I can start arrowing back, and you can see each day by day. In fact, it was very recently, it came very close to that top of that cone. And that's, of course, when we had the big drop in the market, 1,000-point drop in a day or so. And you can just go all the way back and look at this history. So now I've made a little slide to put this together. Let's see. And so we've talked about this vertical skew. Each individual month has this vertical skew. And here's the at the money right at the bottom. And we're talking about if we're projecting a price up, you'll see the vols rising. Whoop, I went back one. And now I put them together. Here's the horizontal skew with the 30, 60, 90, 1 year, 2 year. So you have this long skew. And it's almost like these vertical skews are sitting right on top of it. So as that horizontal skew is shifting, so are these vertical skews. They're like pasted right on there at the money. And so each of these numbers along here, if the whole horizontal skew is dropping, so will all the IVs, and vice versa as the horizontal skew is moving up. So it's a very complicated model with a lot of moving parts. And I'm going to show you in a couple minutes where it really comes in handy. But let me see real quick. I'm not sure if I can see if there's any chance. I'm not sure where to look at it. Oh.
Just one question. Curtis asked, how did you get that horizontal skew chart to appear on the main voltage charts?
Right here when I open the voltage chart, down in the bottom left, there's two buttons, a V, and clicking that V takes this little, shows you a little average table. And the M takes you from just being an IV and an SV line to showing you each of the individual months. And when you click in, that's where you see it day by day. So down in the bottom left corner, these V and M buttons, it's the M button that you'd use. Now let's go back into, let's see what I got. Keep a lot of stocks out here, but one of the places where it's the most useful is in earnings. Because we go one step further with stocks. When we're looking at earnings, let's choose Nike. What I did was I keep some of the ones that are coming up. I can see there's earnings dates coming up, and these ones have 9/22, 9/24. So these are coming up this week. And I'll tell you if it's before the market open or after the market close. And I'll start with Nike, and I'll just look at the price chart. And here, there is a little triangle with an E on it, show earnings announcement dates. So I can see where the past ones were, these little blue triangles throughout, and see how things moved. And you can see how much it jumped. Now let me superimpose the implied volatility. And you can see here's this jump here just above. The price jumped, but goes straight down. What happened to implied volatility? It plummeted. Right here, what happened? It dropped. Price went up, implied volatility dropped. And if you look at those M's, you'll see it's, again, as we mentioned, it's this 30-day that drops the most. As you go back and forth there. Let me go up to this one. You can see how implied volatility is pumped up a little bit more in the front month, but then as soon as you go, it drops the most there. So let's take a look at what that looks like in the matrix. This one has weeklies, which is always useful when you're doing earnings because it lets you get an expiration that's much closer to the actual earnings date. Remember, this one is September 24th. So now I have a weekly 5 that's coming due this Friday. You can see this at the money is at about 44.6 and 44.3. Over here in just 12 days, it's much lower, 33, 29. So now, not doing anything, let me just click this model button and let's look at the volatility model for Nike here. And you'll see in this horizontal skew, there's actually a future event date that's automatically brought in. OptionVue knows that Nike is going to announce earnings the 24th after the market close, so that when it opens on the 25th, that the volatility is going to start dropping. And you can see exactly what it's doing when you flatten the curve, or you can set it back to normal. But let me just show you how that works in an actual projecting a trade. I think I'll go out about, I like to go out at least like 30 days on the long side. So I'll do a calendar, at the money calendar, horizontal, selling 10 of these and buying 10 of the Octobers. Let me hit analyze. Now I can see here's today's line. I'll up it up to 5 lines so you can see it a little better. And you can see as you're coming up here, I think I will change one of my settings in the preferences to make it easier for you, which is in the graphic analysis, I can just display the dates rather than how many days to each line is. So when I hit analyze, it will show us the actual date of each line. So now let me go back. This is 9/22. This one is 9/24 and 9/25. Now I can show you exactly how much the variable volatility model, including these earnings and a projected vol crush, is going to affect this trade by going back, and there's a variable model. There's a variable and EIOIO. And here is the variable. This is, let me make it a little bigger. So here's where the variable model is saying that it's at. That right now it's undervalued, and all of a sudden after the 24th, then there will be the big jump. Let me see if I can try it on a different one. Bed Bath & Beyond is also coming up. And I have the same type of exact trade in here I was looking at. What's the big difference is, let's say at expiration or after the 9/25, it's going to say at the best, if the price does not move, that I am making about $480. If I did not take that into account, which is what the EIOIO model does, it's going to say I'm making about $810. Not quite twice as much, but making the trade look much better than it really is. And especially, what if it does move? What if it moves down to these little blue diamonds are actually where the market is currently pricing the move. So if you look at a straddle, what is it pricing the straddle at? An at-the-money straddle. It is pricing it so that it's going to move somewhere in this range between the two blue diamonds. If you chose one on the left, you'd say, here it says if it does move that far, which is what the market makers are expecting, then you're going to make $400. But looking at the variable model, again, T25, and at that same amount, it's going to say, actually, you're going to lose $220. So if you think it's going to move down like that, it's actually not a good trade. But if you're using a model that just simply takes the current volatility and projects it out, it could make you get into a trade that is in fact not profitable. As long as I'm doing this, I'll also go just a little bit more into what the difference is between the variable volatility model, which we just pretty much went over, and EIOIO. I know it's a very long name, but we call the Volti model EIOIO because it stands for every individual option is its own volatility. And so what we're saying is that we're not calculating or drawing any best fit line or anything. We're simply saying, here's the implied volatility, 18.8. There is this volatility skew that's drawn. We're saying right now, everything, we're just assuming everything is perfectly, fairly valued, and it's going to continue that way. I actually have a test in ES, which is a fairly complex trade that kind of shows also some of the limitations of this EIOIO model. I look at it. This is actually a fairly complex delta neutral trade. And here's where it's at right now. Not doing good, losing a bunch of money. But that is using the EIOIO, and here's using the variable. It's going to look very similar. But here I'm showing for each individual, this is again the S&P 500 E-mini at the CME futures. And so these options are on the futures this November and October and November on December future, which I do have a position in the future at 28 contracts. As you're going down, you see these MIVs being calculated. As you go too far down, especially depending on time, you notice after about 1815, it's not even possible to calculate an MIV. And same thing down here in November after 1750. MIV is blank. When that happens, and it happens again if you go very, very far out of the money, there's just simply not really any way to calculate an MIV. If everything here is trading at a nickel and 20 cents, all the way from 22.25 to here, even though they're the same price, they can't be the same volatility because the strike prices are different. Just being the same price implies a different implied volatility, but you can't tell what it is. But with our variable volatility model, we simply just project out the curve. And so once you stop being able to calculate an MIV, this EIOIO model defaults back to the variable volatility model. That's a change we just recently made in this version that we released Friday. Prior to this, all these years, what we did, when you couldn't calculate the implied volatility, we just defaulted to the average implied volatility of the uniform model. In other words, gave it all one number, 7%, and just used 7% for everything. So we think this, for people who use the EIOIO model, it'll be a big help for them, especially for people who have positions way in and out of the money. So while we're in here, and I wanted to show this more complex position to show you a couple features in the matrix to help you manage your positions better. And one is, you'll see where I am. I have existing positions, but you can't see them. Over to the right here, there are some arrows. And if I click these arrows, boom, it brings me right back to where my existing positions are. And it's still showing me, oh, you still have some up off the screen. And those are over here in October. So that's one way to quickly get to your positions and see where they are. Same thing in the puts. I have some down there. Take me down all the way. And you can see especially in these, which one's the, here, all these, I can't calculate an MIV here. So I have all these positions all down here where in the EIO model you could not calculate a good volatility, where the variable volatility model always can. I also want to show another feature we just added in this last version, which is when you do have a lot of positions in the calls and puts, you have the ability to, right here in the upper left where it says options, if you actually click on the word options, it'll change to the word calls. And now you're only looking at your calls. All these numbers down in the summary section, including your delta, gamma, theta, vega, only refers to your calls. And if I were to hit analyze, it's only going to analyze the calls I have. If I click it once more, it goes to puts. And so now, again, all these numbers down the summary section refer only to my put positions. And if I hit analyze, you'll see those are only graphing and projecting my put positions. If I click it one more time, it goes back to seeing all the options. So this is kind of an extension of what we've always had in OptionVue, where you could say choose an individual month like November. So now I'm only looking at the November options with the underlying contract here, or October. And if I were to hit analyze, you'll see everything that's up here is only the October options. Here's only the Novembers. So that's an easy way to just see different months, calls or puts, anything like that. Now, we did talk about reconciling positions. Don't really have anything set up in this one. Let me see. Might have an SPX. Let's see. Let's call it SPX. And see what I have in here. Look and see if I just happen to have, because just before we started, Tom was talking about trying to reconcile different positions and being able to look at different ones separately.
Well, or combined. So say you had 3 different reconciled letters. You can only pick either all or one of them. You can't pick like 2 of them at the same time.
Right. Well, I will show you on this one that's another new feature we just added, which is in this particular position, and I'll go up to more lines so you can see it. You can see it's kind of, right now, it's just fairly bullish looking at these current ones. But if you were to look in the transaction log, you see that there were a number of trades, and then there was one I made today. So I added these 2 calls, 2 at-the-money calls out in October. And that would be these right here. Those were done today. Now, over here in the upper right, there are a number of buttons. One of them is closing trades. If I wanted to close this, let me just change this back to trade for a minute. If I wanted to close this trade, I could just click this button and it's automatically going to put in the offsetting trade for every one of my positions. And if I were to hit convert trades, this whole thing would be closed. Of course, I don't want to do that right now, but that's what one of these buttons does here. Another one is the side-by-side analysis. That's been around a while. I'm sure a lot of people are familiar with that. But here's the new button. It's got a little X on it, and it says ignore today's trades. So when I click this button, boom, it took out that trade I made today. So you can see, here's the original trade I started the day with. And if I had not made that trade, here's what it would look like right now. I would be up $364. So now I can click it. You can go right back, include today's trade. So you can see now it's totally changed the graph, and instead of being up $364 by doing this trade today, it's up $1,031. So it's worth $700, so that was a good trade. Now, I'll just mention one other feature. It's been in here a long time, but I notice a lot of people are not that familiar with it. It's unrelated to the modeling in many ways, but if you right-click on any column, you can always see all the parameters available. These first column are all actual data that's coming in. Actual data that'd be coming in from your data feed, the last price, bid and ask prices, open, high, low, close volume, open interest. Next one has things like the symbol, your trades, existing positions, commissions. The next one is all mostly calculated, the next two really. Theoretical price, showing the difference between the theoretical price and the market price, percent over undervalued, time premium, various MIV, midpoint MIV, bid ask projected, which is again the volatility skew, percent to double, which is a measure of leverage. What percentage does the underlying have to move for this option to double in price? Probability of finishing in the money. And then the last one in this column is the probability to touch. The last column are all the Greeks and Greek sphere position. But the one I was going to refer to is the probability of touching. When you put that in, I've already run it today, so it's showing me that the probability of the SPX, the index at 1965.70 right now, the probability of it ever touching 1980 is 79%, anytime between now and when it expires in 33 days. You'll see as you move over, the percentages get higher because it has more time to go up there and hit it. Of course, if they're already, if it's already hit, it would be at 100%. So it's only starting out at the money and just out of the money. If you go far out, chance of it going down to 1800 by end of November is only 36%. And what this uses is a Monte Carlo calculator. I'll choose a little different one, maybe that's a regular stock. I'll choose Apple because so many people like Apple, it seems. I'll choose probability of touch. Once you choose it, only then does this button, the PT button or probability of touch button, become available. Once you click it, it will then calculate everything. So now you can see something with every 5 strikes, there's quite a more difference, easier to see. Going all the way up here, 89 days, 14%, not a good chance. Coming closer, you can see actually 125 only has a 3% chance. Well, there's only 5 days for it to do that this week. Let's see, are there any other questions? I don't want to keep going on.
Yeah, there was a question. Can you show the new options, calls, puts feature? I was thinking showing that it'd be kind of nice if you could hide the one you're not seeing. So, if you were just showing calls, just hide the puts. You could see more calls. It's an idea.
We can always drag this anytime and show more or less if there's available. We're saying automatically.
Or another
Let's see.
would be to only show strikes where you have positions or trades. Because sometimes these trades, like an M3, for instance, you have a lot of different strikes in play. So if you could have the option of just hiding the ones you're not using, it would make it easier.
Let's see. Oh, one thing I noticed we also have people have asked us a lot of questions about is things like our history, our price history data, which includes things like our price charts. It includes our volatility data, including each of these individual lines, the 30, 60, 90, 1, and 2 year. And then also, it includes something that's a little more hidden, which is the put call data. Let's see. You can create your own put call volume ratios. We have all for the puts. We have dollar volume, and open interest. So let me just choose volume, and I'll keep 1 day just so you can see the actual volume each day of the puts, the actual volume each day of the calls. And then you can calculate like a put call ratio or whatever you want. But once you set this and then display it, you'll see each day at the reading on the bottom there, we do have call volume, put volume, call volume each day. So we have all this history. And some people would like it, say, in an easy-to-use spreadsheet form or something. I could show you how it's easy to use our data, and it would be by going into, you'd actually have to go into your Windows Explorer to the C drive and find your OptionVue 7 folder. And in OptionVue 7 folder, there is a folder called HIST, which is the HIST files, the history files. And in here, you'll see there's all the different symbols. And let me choose one like let's go with Apple again. AAPL. You'll see each of them have a symbol.asc. It's an ASCII file. But really, I can just double-click to open it. And I can open it in something like Notepad here. And you'll see that it's just a simple common or limited file. In this file for Apple, we have the date, the open, high, low, close, volume, open interest. Here's where the call volume, put volume, call open interest, put open interest, dollar volume. And then we have the IV, SV, which you see in the chart, but also the IV 30, 60, 90, 1 year, 2 year. So all that is available to you. And if you were to do something like save it somewhere as on, say, my desktop, and then what I would do is I would rename it, and I would you could change it to whatever name you want, but the key thing is you want to change the extension to .csv, which is common delimited file. It says, oh, that might make it unstable or unusable. Are you sure you want to do that? Just say yes. Now I can open it in Excel, and as a CSV file, it'll open up in very nice columns. So I'll have all this data going back to all these days. So as I pointed out, because it's a common question that they have, it's easy to get that historical data to use for whatever they might want to be testing. Probably getting near, or I should ask for questions, but I'll show one more thing going back to the earnings and the modeling. I showed you some of these I have coming up. And you might wonder how I know what's coming up, and it is up here in the upper right in these icons, there's an E. And in this E, there's an earnings search. We also have an earnings play module that you can get. And the earnings play module is a specialized module that actually finds and shows you what trades are coming up. But every program is enabled for the earnings search, and you can choose something like up to 5 days listing companies that announce earnings. You'll see here's basically all the stocks in the next 5 days, so quite a lot of them. But I'm really only interested in the ones that have options. So if you check this box, you'll see that everything is highlighted here that has options. Then I go and say I don't really want to trade any stocks that are less than $5. And then I also exclude them if they don't trade at least $50,000 in options a day. And here's where I got a whole group of them. And now I could just click this insert button and it will insert it wherever you are on the quotes display. And so that's an easy way to find what earnings are coming up. Any of these columns on the quotes display you can sort by, in this gray header bar, just right-clicking. So if I right-click here, the ones that moved the highest percentage today are at the top. The ones that have dropped the most are at the bottom. Or right here in the earnings date column, I can right-click and it's going to show me the more recent out to the farthest out. And of course now, because I already had some of these in here, if I sort these, you'll see I have 2 Accentures. I can sort it by symbol, 2 Bed Bath & Beyonds, 2 Carnivals, 2 General Mills, 2 Nikes. But you can also sort it alphabetically by clicking this A at the end of the group header bar. And the difference between right-clicking over the symbol and clicking this A is that when you click the A, it not only sorts it alphabetically, but it removes any duplicates. So you now see I have just one of each in this group. So actually, let's see. This is one of the ones, this CarMax is actually one of the ones that's coming up that would be a recommended trade in our earnings play module. You can see it's coming up 9/22, which is tomorrow. They're going to announce before the market open. So by today, if you right-click, you see these earning notes. These earning notes are for you to put whatever notes you want in there. You can, and there's also a note column. You could write whatever you want in. But if you have the earnings play module, the earnings notes actually will bring in the information for the trade. So in this case, it's showing you that gave it a quality rating of 37, which stands for 37%. It means that on average, if you made, it was last 5 out of 8 times it was successful, it made money. But if you did all 8 trades, you'd have 5 winners, 3 losers, but you would have averaged 37%. So in other words, some would have been higher than 30%, 7%, the winners. Some would have, of course, been losers. But if you did 8 trades, you'd be averaging now 7% return. And it tells you what they actually do. You could buy a straddle or strangle about an hour prior to the close of 9/21, which is today. And then you close the position anytime the following day, although historically it's been profitable hold until near the end of the day. And what I know that means from experience is when it opens tomorrow and you have a gain, it typically tends to kind of run in that direction a little more throughout the day. And then if you close it by about 2:30, an hour before the close, then you'll make more than if you had closed it right away. However, I've also noticed that if it opens and you're a loser, you're better off just closing that loss right away. Let's just take a look and see what CarMax looks like. It does not have weekly options, just October, so you'd have to do something in the front month, and you could do a straddle or strangle, but I would typically just do something like delta neutral strangle. Let's see what 10 and 10 is. 10 and 10 is pretty delta neutral. looks like that. So you can see that's the variable 1 day. Here's the EIOIO. So they're saying you can lose up to 5,600, but here's the 922 tomorrow. You'd only hold this a day. That's what you're worried about. The EIOIO says here's where you'd make money or lose money. This green triangle down here is telling you this is actually the average percent up whenever after earnings that CarMax has moved up. On average, it's moved up here about 9%. And again, these blue diamonds mean here's where they're pricing the options at. And now the red is telling you when it's moved down, here's the average it's moved down. So on average, when it's moved down about 7%. But they're pricing it here at moving about 9%. It doesn't look so great on the EIOIO, but we'll try the variable, which again, it's going to bring in this future date tomorrow that they're announcing earnings, and here's the projected drop in implied volatility for each of those times. Again, you can flatten the curve or zero it out, flatten the curve. That's what it looks like now, right now. But we're projecting it's going to go here. So now when you analyze it like that, you can see you're not profitable till you hit way out here and here, right about where they're pricing it, as I said. However, again, so it's saying it has to go down to 57.30 or up to 68. Well, I could just look at the break-evens. It has to go up 9 or down 9 to make money. Again, let me use the EIOIO, and I keep going back to EIOIO because that's typically the model used by other systems, such as most of the brokers or other online or other programs. They just simply use an EIO method, which is going to show you this. It's going to show you this only needs to go up 2% or down 3% for you to make money. So it's making it look a whole lot better than it is if you're not taking into account the fact that the vol is going to be crushed tomorrow. Now, we do give you the option up here to actually put in something manually, like minus 20. You'd have to know or be smart enough to say, oh, this is going to drop 20% tomorrow as soon as they announce earnings. All right. Let's see, went just a little farther. I want to leave a little more room for questions, but maybe there won't be so many, so let's try to get them. So why don't I open up for questions?
Lewis asked, could you go over setting up vol for a collapse after earnings? You kind of just did that.
Yeah, it's pretty easy. I got all these ones with earnings coming up. Let's try one we haven't looked at, like Carnival. Just go right into the horizontal. See, again, I can just click this little, set the expected voltage change to 0. This is how the actual volatility skew is right now. The horizontal skew is now. You can see it as you're going across 31, 28, 28. I'd have to move this over a little more, I think. 26, 27. It's pretty flat. It's actually better to look at some, again, that have maybe, and it doesn't even have to be this far. Let's see what else I have out here. Here's one on 1013, Intel, pretty far away, but it's got weeklies. You can see it's not really even come into effect yet, but here's where it's at, and we're going to say come October 14th, it's going to drop down to here. I guess just coming in here and playing with these buttons, you're certainly going to see it more if it just so happened we were closer to something like an Apple, a Netflix, or something like that Tesla, about to announce earnings in the next couple of days. That has a much more dramatic effect. And it also doesn't have to be earnings. If you went into a stock and you're analyzing it, and let me find, let's see, something, just, I don't know if I know of anything happening, like something like a pharmaceutical stock or something that does not actually, well, this one again has earnings already built in for the next month. But what can happen is if you're looking at something like a pharmaceutical stock or something and they are expecting like a big FDA announcement, then you could also see in these front month options and weeklies that the vol's pumped way up. And you know that as soon as some important announcement comes up, people are expecting this announcement sometime. I don't really follow the exact dates of FDA announcements or anything myself, but I know people that do. Then you could go ahead and go right in the model and change that date. You could say, oh no, I know that on 9/28 they're going to announce their FDA announcement. And you can flatten it out as of this date by clicking again these buttons, and OptionVue will say, oh, it's going to go back to these normal. You can just check what it's projecting it's going to go back to, and you'll see how it's, in this case, you know, in the case of a FDA announcement, these would be so much higher that you'd see maybe these are dropping 40, 50, even 80%. Sometimes it's up around 100, where these farther out ones may not be anything like that. So you could actually put in an event yourself as opposed to just all we bring in automatically as earnings.
And all that volatility modeling for the earnings, that's available on the non-pro version too?
Oh yes, that's built right into the heart of every OptionVue program.
Okay. Quick question about BackTrader. Is there any plan to change the time series increments to less than 30 minutes, for example, every 5 minutes?
Yeah, no, not this time.
Okay, I had a question about the wand on the analyze chart. I know when you showed when you click on the D, you get like the projected P&L. Is there an easy or a way to see the Greeks that are going to happen at that point? You know, when I grab the wand, you know, it's hard to keep it still to look at the Greeks.
Oh, well, you mean just in the graphic analysis of a position?
Yeah, just pull up any analyze chart.
Yeah. Oops. Let me switch back. Switch back to the scout. All right. So, of course, down at the bottom of the graph, it's showing you at each of these intervals what your profit loss, delta, gamma, theta, vega, and
right.
the maintenance margin.
And if you hold the wand, you'll also get that, but sometimes, you know, you can't
specific.
You can't have it always stop exactly where you want it, unless you type in the number on the left.
Right.
But then, how do you see the Greeks?
You mean when you hold it down?
Yeah, I guess you just have to be careful not to move it.
Right, or you just simply make it one of the intervals that you want. You can move this around so that you can see the reading right under it.
Yep.
You can also adjust the intervals by saying, I want a little different center price, a little different interval between numbers. You can squeeze it up by going up and down here. And you can go use these numbers. You can squeeze it or magnify in. You can also use these little over here, a little left and right. We'll do the same thing as doing it right in the chart as I was doing. Go a little left.
Another question, the topic of weighted vega has been pretty hot in our community. Are there any plans to add that into OptionVue?
No, I just finished doing a lot of testing on the models that we released this week, so I haven't even had a chance to look into that at all.
Okay. Well,
Each of the things I do, it takes quite a bit of research and running and testing. I mean, just these changes we've made recently to the variable volatility model probably took 6 months of testing. Of course, you have to make sure it's looking good.
wait.
I will mention, based on that too, that the more and more research and testing I've done over the years, it's become harder. It's, you know, I guess when I think of it, you know, and someone saying, oh, if the price goes up to here in 10 days, what will be the change in value of this option? That's, of course, what you want to know. And as I mentioned before, the key component of that change is the change in volatility. And, of course, people want to know, well, what is that number? What's the right number for the change in volatility, or what will be the volatility number in 10 days? And one thing that makes it exceptionally tricky is looking at many, many tests. That if we were looking at something like a 5% move in 10 days up or down, doesn't matter, that the path that it takes to get there significantly affects the volatility number it's at when it gets there. In other words, if it kind of meanders around for 8 days, and then over 2 days it plunges, you know, 2.5%, 3% each day, the volatility is going to be quite higher than if, say, it plunges in the next 2 days and then meanders around for the next 8.
Right.
So the path that it takes to get there has a significant effect. So that's one thing that makes projecting future volatilities tricky.
Okay, couple more questions. Let's see, Bill Burton asks, the quote buffer seems to fill up when using toss feed, requiring closing the program and restarting up to 3 to 4 times a day. Is there an issue there?
Only that they only allow about 75 at a time, so we're constantly cycling through, and if toss gets filled up or backs up, there's not much you can do. If we could do more symbols at a time, it would help. I think they need quite a bit of money there. We have the same problem with IB, although IB, as long as you have a couple $1 million there, they'll give you more symbols.
Well, you can actually buy more symbols from IB.
You can also buy them, yes.
Like $20 or $30 a month to buy more symbols.
I think $20 or $30 per how many? Not many more. Per 100?
It went from like 500 to 1,000, something like that. So it was enough for me to run SPX. We had another question. He says, instead of tracking how individual strikes price changed over a period of time, is there a way to track spreads, particularly butterflies? Like, is it possible, for instance, to plot the price movement of an individual option or spread?
No, we do not have that.
Okay. Also another question, can we do combined analysis of Greeks on pairs of future and index trades? I think you can. Like, I know when you have SPX, you can also add the futures in.
If they're the same, you can. You need quotes on both, of course. So in SPX or something, you can bring in the ES or SP futures. In something like the NDX, you could bring in the NASDAQ 100 futures, or there. The RUT, you could bring in, I think we TF, which is the mini options at the ICE. So you can bring them in. You'd have to just define them. I think you'd have to go to define and just bring them in.
Yep.
I don't know what the RUT is right offhand. I guess let's bring in the ES into the SPX. Oh, there. I actually have them already set up. So here are the ES futures. If I go to define the futures tab, you'll see it has ES in all the various months. So yeah, then I can, but if you're talking about the options of each, for example, you have option position in ES and you have option position in SPX, that you cannot do in the same matrix.
Yep. And then one more question. Bill asked, will TOS sell a better feed or give it with a larger account? I'm not familiar.
Not really been that involved with the feeds. Maybe one of our tech people like Kendall and David Johnson here probably knows a whole lot more about the feeds. They've both been working more on that side, developing it, and of course troubleshooting and helping people and working with each of the various available feeds with eSignal, TOS, or IB.
Right. Okay, I think we're just over an hour, and we're out of questions, so it's a good place to stop. So really appreciate you coming on, Jim. Nice to see all the new changes with OptionVue and learning a few things along the way.
Yeah, I'll just mention that we've really been incorporating this earnings in a lot of things. So we did announce a new class, which is being taught by Frank Fahey on earnings and including how to trade earnings. So really involving the new modeling we're doing and trying to take advantage of that. Try to help people to make more money.
Right. Okay, well with that, any last words before we go?
I'll just mention on our OptionVue site, if you go to support, there are helpful how-to videos here if you click that button. And we're also on YouTube, but we have it on our own thing. So you can come out here, you'll see there's many different videos on many aspects of the modeling, on OptionVue, ways to use OptionVue, so you can always take a look out there too.
And if they have any questions, is there a good email address for them to send it to?
Yeah, just finish up by putting up my, my last slide here, which is thanks for coming. My name is Jim Graham, and my email here is just jim@optionvue.com. We also have just general support at optionvue.com.
Okay, so easy to get a hold of you guys, so appreciate it.
Oh, yeah. All right, thanks very much, Tom.
We'll do another one of these next month, and just make sure if you want to attend, get on the list, and you'll get the emails for the meeting automatically. So thanks again, and we will see you next time.
All right, have a good day.
All right, you too. Bye.
Bye-bye.